What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down different levels of options trading strategies. There's going to be a lot of videos coming out around the different levels here, giving you guys some more options insight here. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. So we're going to get right into it here because, again, if you're brand new to the investing journey and you see people posting about options trading strategies and making a lot of money, there is a lot of risk here. So the more we can bring to light, the better off you will be to be on a successful journey to financial freedom. Now, when you start looking at different brokerage accounts, I thought it was the same across the board. It is actually not. When you do open up a brokerage account, not everybody is given options trading or options levels right away. You do have to apply for options levels, and there's a questionnaire you answer, and based on the questionnaire, it'll tell you what level options you have available. So Webull, for example, you can get up to 4 levels of options level trading, which I didn't know that. But if you go to Robinhood, for example, it's only 2, level 2 and level 3. Very interesting. So we're going to kind of break down the ideas, and today is going to be focusing on level 1 and level 2 kind of together. So on Webull's levels, it's level 1 and a little bit of level 2. And on Robinhood, it's just level 2 only. So we're going to be starting off with the basics here that almost everybody can be approved for, no matter what your questionnaire is, what your answers, I should say, are. Level 3 and level 2 and level 3 on Webull are the ones where you do see a little bit more of an advanced strategy, and you can make a lot of money from it, but you got to be very careful and knowledgeable as to what you're doing. So we're focusing on the basics for today, and we're going to kind of just explain the options chain universe, how it works, and the 4 major things we're covering today is going to be covered calls, cash secured puts. If you see buy rights like on Webull here, I looked it up the other day what it is. A buy right just basically means you're buying 100 shares and you're going to write an option or basically do a covered call. So this is basically just is buying and then doing a covered call at the same time. This is just a covered call. This is a cash secured put. So that's level 1 on Webull. The other thing in Webull that we'll cover, that'll be level 2, is going to be just long calls and puts. And you're going to see that in Robinhood's level 2. If you look at Robinhood's level 2 here, we have long call, cover call, long put, and short put. So these are the 4 major ones that we are focusing on for today. If you're looking for more access and behind the scenes with Fridge Financials, let me tell you about our memberships that we offer here. You go over to the membership tab here and you get a lot of perks that regular subscribers do not have access to. You get members first videos. This video right here is already live for my members here that you will not be able to see until tomorrow if you are not a member. You get member only videos. You get members only posts as well, which has a lot of in-depth analysis and financial education that you don't get as a regular subscriber. You get custom emojis. You get loyalty badges. You get membership shoutouts, as you will see if you are a member of the Fridge Financials membership. You get a shout out with your name on here based off of what tier you are looking at getting. On top of that, what you also get, you get personal behind the scenes look at me personally. It's not me hiding behind the camera anymore. It's me front and center, where you get to have more of a personal interaction with me, Fridge Financials. And not only that, you also get exclusive live streams that only members get, where it's me sitting down, talking about stocks, talking about investment strategies, options trading, financial education, economics, you name it, it's covered in these live streams here. We also will have guest podcasts as well that are more interactive for people that are members. If you are considering being a member, feel free to take a look at it. Go onto the YouTube page here. Look at the membership options that we offer for you. We have the Open the Fridge door, which is $3 a month, and we have the Walk-in Freezer, which is $6 a month. Thank you guys so much for considering being a member here, and I look forward to interacting with you guys in the future. For today. Okay, so let's jump right into it here. So taking a look at ticker symbol NVDA, which is NVIDIA, which is, the largest company by market cap in the world. Now, I don't know if it's in the world or not, but for the U.S. market, you are looking at the largest company market share wise. And so what you'll see here is that you can obviously buy shares if you want to on Robinhood if you'd like, or you can go over to here, what's called Trade NVIDIA Options. Okay, so breaking up the ideas here as to how the options chain works. If you're brand new and you're not really quite sure, you're like a visual, I'm a visual learner myself. If you go into the builder here, this gives you different options as to what you can do. So if you want to be bullish, you want to be bearish, you think it's going to be neutral, you can click through all these different options and it gives you some ideas about being bullish versus being bearish, or just being neutral, or having some sort of huge movement that you'll see right here. So this does give you some good visuals. You can click into them and it can give you a nice little explanation about how to build the strategy and how to do it and everything. But obviously I've been doing options for a while, so I kind of know what it looks like already. Also, if you go onto Robinhood, you can take a look and say, hey, here's the basics of explaining what a long call is and the calculations behind it, what the chart looks like, and how you can monitor it. So Robinhood actually does a very good job of explaining all the option strategies here. And obviously, as a full disclosure, these are hypothetical examples, and please do your own research. And I am not a financial advisor, neither is Robinhood, right? So make sure that you are doing your own due diligence so you don't lose out on a lot of money here. So before you go into any sort of trading with options here, you have to become familiar with, again, there's the builder if you want to build an option yourself, or you can go into Robinhood's website itself and take a look at it, which I did there. You just type in level options Robinhood and it pops up really quick. You have to be familiar with the top up here. So we've got the builder, which helps us with visualizing what we're doing. We have buy, we have sell, we have call, we have put, we have the expiration date. In the stock market universe and in the options world, buying means that you are paying for it, which makes a lot of sense. And then selling means that you are the one giving the contract away. You're the one who's on the seller side. Just like when you go to any store, if you go to the store to buy something, there's a seller on the other side. Same thing with option exchange. You can either buy an option or you can sell an option. So those are pretty much right here and here. So you have buying options, selling options. You also have what's called calls and you have puts. Now, the idea behind this is that a call option basically means that you are hoping that the stock price is going to go up. A put option means it's going to go down, which makes a lot of sense. Instead of going, I don't know why they do call and put. I would be curious to know what the research is to this. I would just do up, down, put, that's just me. And you also have what's called an expiration date, which means that these are all contracts, right? So you're basically like signing a digital agreement, a contract that this has to happen. The stock has to do this by a certain point in time. Now, as you'll see, it's not just one day only. It could be for 50 days. It could be for 200 days. You can go all the way out for 2 years if you want to, whatever the case is. There's a lot of options here. Now, this is called the options chain right here that you're looking at right here. So that's something to become familiar with to start off with. The other thing to become familiar with is strike price, break even, which basically means you don't lose money. Because again, if you're looking at options here, there's a chance to make money, a chance to lose money, which means there is a break even point, which is obviously you come out with $0. Chance of profit, which is a pretty good tool to look at. Percent change basically means how much is did the option change in terms of price action and how the price is moving the stock, the change overall, and the price that you have here. So you have strike price, break even, chance of profit, so on. And you can change this, I believe, as well. I don't know if you can do it. I don't know how to do it on here, but I believe on the app for Robinhood, you can actually change up all these columns here. It's pretty cool. Okay. Let's go into Robinhood's first one here, which is called the long call. Now, again, here's your little description. If you want to pause the video and you want to read through the description, you can definitely do so. Basically, you're being bullish. If you ever hear about the word being bullish on the market, that means that we're being very, very optimistic of the market going higher. We're pushing higher, pushing higher, pushing higher. It's a bullish strategy with momentum. Okay. So long is describing an ownership, meaning you hold the option. Owning a call option gives you the right, but not the obligation to buy 100 shares of the stock at the strike price by the option's expiration date. Again, a lot of words that are going on here. So one thing to make sure that they talk about here is that a options contract gives you control of 100 shares. So it's not just one share, it's 100 shares worth of the stock. Basically, it's called leverage, which means that instead of having to buy, so if I wanted to buy 100 shares of NVIDIA right now, it would cost me almost $15,000. Or what we could do is I'll say, you know what? I want to own the 100 shares in NVIDIA for only about 30 days, whatever the case is. And you can buy one of these options here for a lot cheaper. Now, the price here that you need to understand, it's not going to cost me, for example, $4.70, as you'll see. It costs me $470 because this is the price you're paying for every share. And remember, options contracts trade in increments of 100. So $4.70 per share times the 100 shares is where you get the cost basis of $470. Okay. And that's really important to know because a lot of people say, oh, I'm just going to pay like $5 for this contract. No. You're paying 500 for this contract, not 5. So understanding that you're paying that much per share, not for the entire thing, really will make a difference for you as you start your options trading journey here. Okay, now let's talk about exercising options and everything. And I want to go into that aspect in today's video here, just kind of giving you guys how to start options contracts. There's plenty of videos that will be coming out around this here, and I don't want to go too crazy with it. But so let's say that you want to be bullish on NVIDIA. You're a NVIDIA user, you have it in your PC, you have it in your laptop, whatever it is, you're bullish on NVIDIA long term. So if you're bullish, you want to buy a call option, which is what you're going to do here, buy a call option. And here's how this is going to work. Let's say that I'm going to go between now and the end of the year, basically, December 19th. So about, 6 months out or so. I think NVIDIA is going to push up higher to, say, 160. Okay. I'm going to make a bet, and I'm going to bet the market. I think NVIDIA will be at $160 per share by the end of the year. Right now it's at about $150, so another $10 move in the next 6 months. Not a crazy, unexpected move because, again, NVIDIA moves a lot with earnings reports and AIs and everything like that, right? And so what you'll notice is that, again, you're saying that NVIDIA is going to go to 160, you're hoping for, but what you'll notice is the break even is 173. So you actually will only break even at $173.05. Now, why is it the case and it's not 160? Well, it's because, again, remember, your cost basis, you're paying for NVIDIA to go to 160, but you got to pay $13.05 for every share of NVIDIA. So if it hits 160, you still lost your $13.05 because, again, you paid that much for it. It's a cost basis that you have. So how the break even is priced out is you take this right here, your strike price. Oh, it's moving because it's 8 o'clock in the morning, so don't freak out. This is like the 8 o'clock like liquidity movements in the morning. It's actually kind of wild sometimes to watch. You'll take the 160 strike price here, plus what you're paying per share, and that gives you the break even actually. So if it goes to 173.05, anything after that is pure profit. As you'll see, this nice little chart here tells me, hey, I have a lot of green potential here once I get past that break even point. And again, remember, your max loss option here is $1,305. It's not you're paying $13 only, you're paying $1,300 because, again, it's 100 shares at $13 each. That's $1,300. So that's buying a call option. Now, if NVIDIA goes above this break even, you make whatever amount of money you have. As it goes higher and higher and higher, you make more and more profit, as you will see. But if it keeps on staying below that, you don't make money. You start to lose that value. And this option is going to start to lose value. And that's a problem because you're losing on potential money here. So if you wanted to buy a call option, you would go to buy call, which means you're bullish. You would go to continue. Then you would put in a contract, say 1. You could buy 3, 5, but be careful about how much you're actually paying for it. Make sure you review how much it's going to cost you. Then you would go ahead, you would go in and get filled as a result. That's how you buy an option. All right. For a call, I should say. Now, believe it or not, the really nice thing is, let's say that you're bearish on NVIDIA. Now, if you ever hear the word bearish, it's the opposite of bullish. Bullish means you think the market's going to go up. Bearish means you're going to go down. Okay, where those came from, there's probably some history behind it. I have no idea. But so instead of buying a call option, betting that NVIDIA will go up, instead I want to buy a put option and say, you know what, Fridge? I'm going to bet NVIDIA is going to go down to, say, 140. $10 move down. Instead of a $10 move up, I think it's going to be a $10 move down by the end of the year. I think the market's overbought right now. I think if there's way too much money coming in, if they were going to have some crazy data coming out with inflation and tariffs, and it's going to crash the market, and NVIDIA goes down. And what you'll see is it kind of looks very similar to the call side, but it's reversed. Instead of being red then green as you get higher and higher. As it goes red then green as you get lower, lower, and lower. So this is a long put option. So if you're looking at here, this is what's going to be called a long put, which you'll see right down here. And again, here's a nice little graph here, right? As the stock price loses more value, you will actually profit more and more as a result. And again, what you will notice is your break even. Strike price 140, but again, you're paying $11.75 for every share. So 140 with this price in here, your break even actually needs to be 128.25 in order to then start making profit as a result. Again, cost basis that you have right here is 1,175 because you're paying 100 shares of these. And your break even is the strike price factoring in how much you're paying for the option itself. Now, instead of adding it to a call, you subtract it for a put because you're hoping that it goes lower, not higher. So keep that in mind as you're looking at the options chain here. There's a lot more behind it, but I don't want to go too crazy here. But that's how you do a long call and a long put, which is basically what we're talking about right here. A long put and a long call. And I got to minimize this because this isn't a lot of work here. And then options, same thing, long calls and long puts. The last thing I want to cover is instead of being on the buyer side, we can be on the seller side. So think about it, right? There's the buyer, there's the seller. If the buyer is buying a call option, so let's break this down here, right? Let me close this out. If you are buying a call option and you're buying and you're betting that Nvidia's going to go to 160, which you will see here again, as it goes higher and higher, I profit more and more. If you are the buyer wanting it to go higher, what do you think the seller is going to be wanting in this case? Well, the seller doesn't want it to go higher. So when you do a sold option here, it's going to be the opposite. The green is up here. It's inverted. It's the opposite because, again, there's a buyer, there's a seller. So if the buyer wants it to go higher, the seller wants it to stay lower to maximize profit. Now, as the buyer is paying $1,300, you collect $1,305 at the very beginning because the buyer's giving you the cash up front. And as the option, as the strike, and as the, as the stock doesn't go to 160, you maximize more of that premium. It's called a premium when you're selling options here. Premiums mean that you're getting paid for it. And again, as you're a debit, you are buying it, right? So you're buying in this case. But in this case, as a seller, you get paid $1,305 up front. And as long as NVIDIA stays over here, you maximize and you get this pure profit. Now, what this is called here is a covered call, okay? It would be, in theory. The basic strategy here is a covered call, which you'll see here, level 1 for Webull, and then it's also here in Robinhood under level 2. Now, it's called a covered call because, or what it would be a covered call, is because you need to have 100 shares available. Because again, you are saying, hey, you can take these shares, these 100 shares of control from me, and you need to have those in case the option buyer wants to exercise and take those shares himself. If this guy wants to buy the $160 for NVIDIA, the 100 shares, you need to have 100 shares available in order to sell a covered call, which is what we're doing here. So selling a covered call means that you need to have 100 shares available. Right now it's called a short one because I don't have 100 shares available. Just so we're on the same page here. So when you're selling a covered call, if you don't have the shares, that's called naked writing, naked option writing, which you don't want. Okay, as a level 1 trader or a level 2, you're getting the options. The easiest strategies that I would say is you can just buy and sell. You can just buy options, but for me, selling options is the way to go because you can sell your shares here at a profit. So say you bought it at 149 and you sold them at 160 plus you get paid this, you're making, $1,100 in the shares plus $1,300 here. You're making $2,400 just by selling an option. And you give it away. You're like, okay, here, take my NVIDIA. It's fine. No big deal. So you're making a lot of money in that case as a result. So selling a covered call, you need to have 100 shares as collateral. If you don't have that, that is going to be a problem. And just like, as someone who buys a put, so if I wanted to buy the 140 put, you're betting for it to go down. But if you sell the put, you're betting for it to stay higher. So again, it's the invert again, same thing. Basically, you're taking this chart and you're flipping it around, right? So as long as Nvidia stays, above 140, you're going to capitalize on that premium as the options seller. Now, with a cash secured put, this is called a cash secured put, which you'll see right here, cash secured put. And it's just like in the name, you need to have the cash available. It's cash secured put here in Robin as well. You need to have the cash available to buy 100 shares if Nvidia goes lower. So for example, if I think the Nvidia's gonna go to 140 and I wouldn't mind owning my shares at $140 here, I could sell this option here. I collect $1,100 here. And on top of that, if Nvidia goes to 140, I am gonna be forced to buy the shares at 140, but I get it at a discount of about $10. So you're getting in for a cheaper cost basis, and you're getting a premium upfront as a result. It's a nice double, it's premium and cheaper shares that you get to buy for a company that you love. All right. And again, you need to have $14,000 this one, for example, because 1,000 or 100 shares times 140 for every share you're being forced to buy, you're obligated to buy. As a option seller, you're being told, hey, I'm going to buy the shares at 140. And if it hits 140, you're forced to buy them. So 100 shares, $140 each one gives you a total of $14,000. So you do need to have cash available. That's why it's called a cash secured put. So if you don't have the cash, like I don't have it right now, my buying power, that would be what's called a naked option, a naked put, which we do not want, because naked options are very risky if you don't have collateral to put up against it. Whether it's shares, whether it's cash, you need to have something as collateral for these kind of options here. So if you wanted to start investing and you want to own NVIDIA, but you think, Fridge, NVIDIA has been on a tear recently. I want to pull back a little bit here. So you can go and get into trading options here and say you want to do a sell or put and say you want to own it a little bit cheaper. This is what I would do as an options beginning strategy here. And again, not financial advice, but this is what I would do. I would go, 30 days out here and I would say, what? I think NVIDIA might go to say, you can look at the research a little bit. I want to buy NVIDIA at like 142, for example. $7 discount. Pretty good discount, actually. You'll get paid $296 up front. Amazing. And you can buy NVIDIA at a cheaper price. So it's great. Now, once you get the 100 shares, this is called the wheel strategy. Once you get 100 shares, you could then go into the covered call side, because again, selling a cash secured put gives you the 100 shares. Selling a covered call is going to give you the collateral in case NVIDIA goes higher. And then you can get in and out of positions pretty quick, pretty easily here. And as a result, it's going to generate passive income, and it's going to also allow you to own shares of companies that you want to own. That's the one key thing here about cash secured puts, cover calls, and the wheel strategy. This right here, the idea is you have to make sure that you're looking at stocks that you want to own. If you don't want NVIDIA, do not do it for NVIDIA, because you will be exercised at some point in time. And you got to be okay with that. If you're not okay with it, then that's where the problem is going to come. I kind of break it down from here. So the first thing I want to look at is to show you is an example of what a protective collar option is. Basically, the way you read into it is that it is based for a hedge in this case. So suppose you own 100 shares of stock ABC, bought at originally $80 per share, and it's currently trading at $87 per share. So you've already made, $700 on the 100 shares you've made. You want to temporarily hedge the position since there's been volatility in the overall market. So hedging, if you're brand new to options, hedging basically means you put yourself in a position where you have some money where it protects your portfolio, and it's not guaranteed to protect the entire thing. But say, you're bullish on NVIDIA and you have a lot of shares in NVIDIA, but it might come down a little bit. You might be able to buy a put option. And again, last video we talked about buying a put means you're betting for it to go down. You might buy a put option as a hedge. So that way if NVIDIA does go down, you lose capital in those shares, but you gain some value in your option that you buy. So a hedge is basically there to offset your potential losses in your portfolio. It's a very popular strategy that people do in their investing in the financial world. hedging is a thing. And so feel free to do some research on hedging. This is one example about how to hedge it here. So you want to buy one put option, again, which is basically protecting your downside, because if the shares go down, the put option becomes worth more. So you're going to buy one put option, which again is worth 100 shares, with a strike price of $77, and you have to pay $3 per share, also known as paying $300. $3 a share times 100 shares means you pay $300. And again, but what it's doing is that you're protecting the downside, because if your shares come down to, 87 or come down to like 85, $80, this option that you're buying here becomes worth more. So even though your shares lose value, the put option you buy gains value. So it offsets those losses a little bit. Now, what you could also do is you could also sell one call option with a strike price of $97. And again, selling options or writing an option, the same idea, is that you're selling an option saying, hey, I bet that my stock won't go to $97. Okay. Selling the option means selling a call means you don't want it to go higher. Buying a call means you do. Selling means that you don't. And so basically what you're saying is that I'm going to sell a call option at $97 here. Basically hope that the share price doesn't go to 97, and you get paid $4.50 per share times the 100 shares that you own gives you a premium of $450. So what you're going to be looking at here is actually when you open up this option at the same time here, what you're going to be looking at is the difference. You're paying $3 in premium here. You're getting paid $4.50 here. So the difference you're getting paid per share is $1.50 times 100 shares gives you a premium of $150. And basically what this is doing is that it is hedging either way. Stock goes up, your shares appreciate in value, your put option obviously loses value. Stock goes down, your call option that you sold makes money, your put option that you bought makes money, and your shares with a little bit of value as well. So it kind of protects you in either direction. So it's very, very a really good strategy to really use and build in your portfolio if you can do a lot of research behind it. Obviously, this is just informational knowledge here. This is not like, here's the go-to strategy. There are different ways of doing this here. They break down the break-evens, the maximum profits, the maximum losses here. As you can see, the max profit is amazing, $1,850, and the max loss is only $150 because, again, of the difference that you're paying here that you're looking at as a result. So you can lose that $1.50 essentially. So that's basically the idea of the collar strategy. You can look more into it as you go. I hate that I don't have 100 shares right now of a stock that I could do it with right now at this moment in time, so I'm not able to do that. But it's just something to keep in mind about as you're going forward in the options game. So if you ever see a collar strategy, it kind of just basically just wraps the stock around two different strike prices, condensing it, containing it, like a collar does, I guess. And then it allows you to basically hedge your potential losses. So it's a really good strategy to look at. That's basically what a collar strategy is. Straddles and Strangles are actually a little bit easier to manage, a little bit easier to work with because they just make more sense. So let's take a look at ticker symbol NKE, which is Nike. So Nike stock, as you know, has like Jordans and the athletic wear, and it's very, very popular. And everybody knows Nike, the nice Nike swoosh and all that kind of stuff. Okay. So how is this going to work? So Straddles and Strangles. So Straddles, Strangles, they're very, very similar names, but how these basically work in level 2 for Webull and in level 3 for Robinhood here, as you'll see level 3 here. And again, you need to have a margin account here. So things to keep in mind about, depending on what brokerage you're looking at. Again, make sure you follow their guidelines about how you do it. And we'll do a whole video about margin later on, so you guys know how I can use margin to my advantage. But back to the actual educational video here. So with Straddles and Strangles here. So the idea behind a straddle and a strangle is that you're basically buying an option in either direction, hoping for a huge move. Okay. The huge moves with individual stocks like Nike, like Nvidia, like Apple, those huge market moves that you usually see, unless there's some breaking news out there, which unless you're an insider, then you wouldn't be able to know when it comes out. Earnings. Straddles and Strangles to me are very useful for earnings, because earnings either gives you some forward guidance, it makes you be more optimistic and the market could pump the stock, or it could come in awful and it could dump the stock. And what Straddles and Strangles do is that they focus on basically either direction here. So let's take a look here. Let's take a look at Nike. And the reason why I do Nike is because, believe it or not, Nike has their earnings coming out today after hours. Now, something to keep in mind about with this here is that when you're doing Straddles and Strangles, you don't usually, it's a really big gamble if you're doing it the day of earnings. Okay, just so you know. Like if you were to do it today, at the time of recording this, before Nike's earnings come out, you're taking a gamble, 100%. But, if you do like a week out, 2 weeks out, it gives you time to see the stock might move. Usually what people say a lot of time with Nike especially, or with not Nike, with NVIDIA especially, NVIDIA usually seems to have a run into earnings. So if you do a straddle with a run into earnings or a strangle with the run into earnings for NVIDIA, you might be able to get that nice profit because it's already running in a certain direction. Nike's been doing absolutely nothing, by the way, for the last week. So last month, kind of been just going sideways. So again, 0.35% move has done nothing. Anyways, trade Nike options here. Okay, so as we covered last time, and again, we're going to do options. So let's say you want to go, here's the expiration date we talk about here. We can go till tomorrow and be a super gambling, risky day trader here. We can go a week out if you want to. Maybe, it takes a couple days for the market to truly appreciate the earnings report that comes out, whether it's positive or negative here. So let's go a week out, for example. And say you're being bullish on Nike. You're like, you know what, Fridge? I think Nike will go to 62. It's at 61.17. I'm going to bet it goes to 62. And again, here's your level 1 options idea where basically as long as Nike goes higher and higher and higher, again, your break even, $62 plus the premium, $64.16. Anything after that is green and profitable. So that's you being bullish. But then you're looking at it, you're like, maybe, I don't know, man. Earnings is a coin flip for a lot of companies. They could have the most amazing guidance possible and the stock still comes down 5-10%. So Fridge, what do I do here instead? Well, what happens if I buy a put option at the same strike? Like this. This creates what's called a straddle. And what you will notice here is that you bought the same strike price, same expiration date, but one's a call option, one's a put option. And the pros behind this strategy here for a long straddle is that if the stock moves in either direction, so this is your put option right here, this is your call option here, as long as it moves, so for example, break even is 7% and 10% here. So the stock moves, 10% either direction, you'll be able to make money in either way. That's what this is doing here. So it covers you on both bases. Basically, what you're telling the market is saying, I'm willing to bet that Nike's going to have a huge move. And I don't care what move it is. It doesn't matter to me. You can move in the negatives. It can go positive. It doesn't really matter either way, as long as there's movement. As long as there's some big movement here, then you're going to get some nice profit on this potential options trade for a long straddle. The thing to worry about here is what's called IV crush. These options right here have a little bit more juice to them because the volatility is increased because of earnings. Volatility means how much your stock is going to be moving up and down. Those meme stocks, those, high risk play stocks have higher implied volatility. If you take a look at an option chain, we have what's called implied volatility. The higher this number is, the more of a move they're looking at for you to have in the stock. Which means that that's the result. Since you're looking at a more riskier move in either direction, it's going to pay costing a little bit more. So these premiums, these prices that you are buying are juiced because of an increase in implied volatility. What does that mean? The problem with straddles is two things. You're paying for two options, so it's going to cost you $500 instead of just betting for either the call side 216 or the put side 320. You're paying for both, so it's going to cost you a lot more money in capital. And also, you have a risk of what's called implied volatility crush or IV crush. If Nike's earnings are just okay, and the stock moves like 1%, 2% even, these options dramatically lose value because they're trying to price in that huge movement. And if the stock trades around here, you're down your huddle $500 really quick. It's called an IV crush. So playing earnings is risky in that aspect because of that nature. So that's the idea behind a straddle. Again, straddle, the pros, it covers either direction. Cons is that you're paying for two options instead of one. And you also have a risk of losing a lot more capital because of IV crush. These premiums are juiced up a lot more. For example, if you want to take a look at, say, like tomorrow's option chain here, take a look at the IV for a bought put option here. It's 166% because obviously earnings are today. This one expires tomorrow. So this contract right here has a juicy premium built into it because of the implied volatility, because earnings are coming out. So just things to keep in mind about when you're trading options. When you get close to an earnings date, you're going to see the premiums and the prices cost a little bit more. So keep that in mind when you're buying options or selling options also. Now, the only thing that's different between a straddle and a strangle is actually not a lot. Say you want to bet that, you're going to buy the option. Say, I think Nike goes $62. Break even is $64.16, obviously, because, that plus the share price or plus the strike price plus the price you pay per share gives you the break even for the call side. We're saying, you know what, Fridge? I'm going to also do a put side, but 62, I'm going to go a little bit low. I'm going to say 61. Right now it's at 61.17. It's going to go just a little bit lower to 61 here. This creates what's called a strangle. The difference between a straddle and a strangle is a straddle has the exact same strike price. Take a look. I'm going to get rid of this one. Boom. Long straddle. Same strike price, $62. Same expiration date, but one's a call, one's a put. A strangle is buying one option as a call side and then buying one below as a put side here, creates what's called a strangle here. Now, what is the difference here? Well, if you take a look at the numbers here. So here is the straddle we just had. It costed $536. The strangle costs only $485. So a strangle, since the strike prices are a little bit farther apart from each other, there's a little bit less price that you have to pay for this option here, because again, take a look at the break even here. The break even for this put was 58.80. This one's 58.31. And again, since your break even's a little bit lower, that means the probability is a little bit lower to happen, to have that option expire in the money. And that means that it's going to cost you a little bit less. The farther down you go in the options chain here, the less likely it is to happen, the lower it will cost. So that's something to keep in mind about. So that's why the strangle is a little bit more of a cost-effective approach. Same thing as a straddle, because again, you're buying two options instead of one call side, one put side. But if you don't have the capital for it, but you still think Nike's going to have a big move to either side, you could make a strangle with cheaper options. So say you want to do like a 65 here, and then so that's what, $4 up, and then you say you want to go $4 down, so 57. So again, this is a long strangle here. You're looking for a huge movement of 10% in either direction, which again, is good for potential earnings play if they have a great earnings report. And it's only going to cost you $200 instead of the $500. Again, the farther away you are from the share price for your strike that you pick, the less it will cost because the probability is unlikely. So that's kind of things to keep in mind about as you go. And again, pros, it covers both directions. Cons, you're paying for two contracts instead of one. So let's get right into it here. So we're going to be looking at trading options here. Now, a lot of people, when people say, how do I start trading options? What's the way to start trading without being super risky? Because again, options can be very, very risky if you're not managing your trades correctly and you're not careful what you're doing. It could be a very risky strategy. So here's what we're looking at here. And I want to use some examples here that I have, so I open some up right now. Again, when you first start off investing in stocks and you want to look into the options game here, a good way that you could do it is selling options. The reason why selling options is good reasonably selling options, is that It's basically how you can get yourself into positions and out of them while also getting passive income, which to me is amazing. Not only are you buying stock that you want to own, but you're getting paid to buy the stock. Not only are you selling stock at a good profit, but you're getting paid to sell it. That's what covered calls are and cash secured puts. Again, the first video we covered both of those, covered calls, cash secured puts. Those are level 1 because those are basic strategies and those are beginner friendly, because basically all you really need to do is make sure you either have 100 shares of a stock or have cash available to buy 100 shares in case it goes against you. All right. So when taking a look here, let me give you an example as to how this can work. And what do you mean by saying, Fridge, how can you do it with such little capital here? Take a look at this for example here. Funny enough, I did one on ticker symbol Bull, which if you don't know is Webull. Webull has been recently in the volatility market craze. And I do have Webull. I use it for my Grok GPT trading challenge I usually do. And it's a great platform. I think it has really cool insights and features. Is it going to be as good as Robinhood in the future? I don't think it is, because Robinhood's doing a lot of really amazing things. But it's a really good trading platform. It's very interactive, very user-friendly, I think. I still like using it. So I don't mind buying, Webull for a stock price here. And what you'll see here is there's some crazy momentum and it pushed up to, let's go back out to here actually. So you take a look at some crazy huge movement here, up a lot, which there's a lot of value here. Then obviously it came back down. Now it's kind of chilling around $10 or so. So I was like, okay, I don't mind it. So this is kind of what I basically did here. And what you will see is I sold a put option. So I'm saying, in 30 days, Webull, if it goes to $9.50, per share, then I will buy it. And there's my cash collateral. Again, $950 in my portfolio isn't a huge amount of it compared to what I have in my portfolio. So I put that money into a cash secured put here. And what happens is I got paid $31 to open this position up. So if Webull comes to $950, great. I own it at a discount and I get paid to own it at a discount. It's pretty cool. Again, selling cash secured puts is very good for stocks that you want to own. Full disclosure, if you're doing it just to make money and think you can do it that way, I wouldn't recommend it, because you got to be okay with hopefully owning the shares of the stock that you have, whether it's through the financials, whether it's through using it yourself in real life, however it is you feel fit. Make sure you're doing it with stocks that you love to actually own. All right. So let's go to trade Webull options here. And again, I'll break down the idea of how I opened this trade up here. So I went down to July 20th, about a month out, or was it a little bit longer than that actually? It was August 1st. I was on the call side. Fridge, you're such an idiot. Don't tell me that. So say you want, again, so basically selling a put basically means you don't want Webull to go below 950. Again, buying a put means you want it to go lower. Selling means you don't want it to go lower. So watch that. Again, we covered that in last videos as well. And basically I said, okay, I'm going to sell a put option here. And basically, as long as Webull doesn't go to 950, I will be able to keep $31. And then the cash goes back to my account. And then I could do it again and again and again and again. And this is about like a 2-ish% return in about a month. Which again, if you do multiply it over 12 months, you'll get, almost close to 30% return for the year annualized, which is pretty good. But you're sitting here and you're saying, Fridge, I just started out my account. I only have $2,000 to my name, and I don't want to put all of it into Webull. Like it's a risky growth momentum play stock. Okay. So here's what we're able to do. And you can do this, again, this kind of leads us into what's called a credit spread. Okay. So say you don't have the cash available for this here. You can't buy $950 worth of Webull stock. All right. What you can do is you can then buy a put option basically for your collateral instead of cash collateral. You could buy a put option as collateral instead, because again, buying an option gives you access to 100 shares worth basically, which 100 shares, you get 100 shares like, whatever strike price you pick it at. So say I want to buy the put option one below and watch what happens as a result. So what you'll notice happens here is two things. Your max loss depreciated a lot more. Your max profit went in a lot more here. But basically what is happening here is you open up what's called a put credit spread. What does that mean? Well, it's a spread because it's spread between two strike prices here. But basically what's happening is that this bought option here, this $9 bought option here, is going to be the replacement of your cash collateral that you don't otherwise have for this sold put option here. And basically what happens is the difference in these two strike prices is the premium that you get paid out up front. Because again, you're getting paid this much, but you're buying this one. How much I get paid versus how much I'm buying it for gives me a difference of $16 here. But what you also notice is that your max loss is only $34. So this trade right here will pay you $16, and all you need is $34 in collateral. And that's what it takes. Take a look. So again, well, actually you need $50 technically. The market's closed, by the way, so you can't do this right now. But you need $50 because the difference in the strike prices here is 50 cents per share times 100 shares is $50. So you need $50 here, and your max loss is only $34 because they're paying you $16 up front. So your collateral goes from $950 down to $50. That's pretty good. That's really good actually, right? Like you can't argue that, right? So you can get into this option here, a sold option, selling options for passive income still, without having to front load a lot of money. It's pretty nice. For example, right? So if this is going to cost me $50 and the Webull one is $950 to open up here, let's say that's going to be what, 19 contracts-ish or so? I think it's like 19 contracts. Let me take a look. Yeah, 19 contracts. You can do 19 contracts of this put credit spread here, and instead of making $31, you can make $300 as a result. You say, well, Fridge, then why would I ever do a cash secured put? And the risk here is this. There's a lot of risks here, which is why it's an advanced options trading strategy here. So you have to be mindful of these risks here. It's not free cash and guaranteed to happen. There's a lot of risk. And I'll break it down for you. One thing to know. With this here, if Webull tanks to $9, you don't come out with anything. You're down to $34, you hit your max loss, and you're done. That's it. If it goes to like $9, $8, whatever, you hit your max loss, and that's it. You're kind of stuck. With the cash secured puts, if it goes to $9, you still have the shares of Webull. So with a cash secured put, you're coming out with something still. Even if the trade goes completely against you, at least you walk away with 100 shares of Webull for $950. And if you did this contract, if you did 19 of this contract here and you did this trade here, you would be walking away with just losing $600 and nothing to show for it. You lost $600, you're done. At least with the cash secured put, you lose the value potentially in the stock, but you come away with 100 shares of Webull still. So if Webull goes to $10, $11, you still have a chance to make that capital back. Credit spreads, you don't. You lose it, and that's it. The other risk that can happen here, which is why it is a level 3 options here, is that there is a potential for you to be pinned between these two strikes here, which is not good. Because say at the day of expiration, Webull closes at $9.25. Well, this expires worthless because it didn't hit the $9 that you bought it for. This expires in the money because it's below $9.50 strike price. And you're caught in this limbo here, basically where you will either have to, you can't exercise this contract either because it's worth nothing. That's the problem. So there is a risk to being pinned in between the strike prices here. And it's a very risky strategy for that reason. So which is why my advice would be, if you're going to go into these advanced trading strategies here, make sure you're closing them before the date of expiration. Do not let it ride out. Unless Webull is trading at like $11, then yeah, let it ride out. It'll expire worthless. But if Webull is trading at like $9.55, a market open on Friday, you better think about how to close it before the market closes. Because all it takes is after hours, Webull gets pinned between here, and then your accountant gets some sort of flag notification about saying like, oh, like this went to nothing. You have to pay for these shares here. You don't have it. It becomes a huge problem here, which is why you need margin as that aspect as a result. So it's a very risky trade if you're not careful with the management piece for it. Something to keep in mind about, as we know. So that is a put credit spread. Now, just like you have a put credit spread, you also have what's called a call credit spread. But this is a good strategy if you don't own 100 shares of Webull, because basically this bought option right here is that collateral. So say you want to sell options, say you're bearish on Webull and you think it's going to go lower and you think it won't go higher, but you don't have the collateral, you don't have the shares to have this get exercised in case of it going up to $12, you could buy the higher strike price instead, and that's going to be used as your collateral instead. Very similar to the put side, but with the call side. Again, risk to keep in mind about getting pinned in between may not be a good idea. And also, again, your profit and loss is a lot less as a result instead of just owning the shares of Webull. Because if I own 100 shares at $11, it goes to 12, I would make $100 here. Here, I'm only making $10. So you are obviously limiting your profit if you don't have the shares of Webull in the account. So those are called credit spreads. Now, they're called credit spreads because you are paid a credit up front. Makes sense. You're paying a credit here. Here is your credit. So you pay them $10 or whatever it is. So you're going to pay $10, your collateral is 50 and max loss will be 40 because again, you had to pay them 50, you get $10 back, max loss will be $40. The other side to the credit spread, which believe it or not is very similar, so this next part will go pretty quick. Instead of it being a credit spread, we have what's called a debit spread. So instead of being the option seller with credit spreads and then using those bought options for their collateral instead, you could have a buying of an option and have collateral the opposite. It's basically the reverse of a credit spread is a debit spread. Take a look at what it means. Let's clear this out here. So say you're bullish on Webull. Say, I think by the end of by January of next year, we will be at, $12.50. You want to buy this option here. But we're saying, Fridge, I don't know if I only have $1,000 in my account. I don't have that much money to go off with. I know Webull might go. I think Webull's going to do very, very well. I think it's going to be a great market investment here. I don't have the money to buy shares though as much. I can't buy a lot of shares of it, but I still want to be able to make some money on the upside here. So your max loss here is $177 here, but your max profit is unlimited. The higher it goes, the more you make money. So again, if it goes up, say $50, you're up $150. You almost doubled your money here. But Fridge, I don't have $200 to my name right now. Okay. What you could do is instead of, again, you could do a sold option one strike above. And what you'll notice happens is your max loss is a lot lower because, again, this one you paid for, this is selling, so this offsets this. It's called a debit spread because the bought option is worth more than the sold option. This just offsets how much you're paying. So this minus this gives me my max loss of $49, but the max profit also is limited to $201, as we'll see right here. It caps out at $201 here. So it's not an unlimited return, but still, you pay $50 for a max return of $200. That's not a bad trade. Not a bad trade at all. It's called a call debit spread. Again, basically using a sold option to offset the bought option and then basically using that to be able to make money as a result. And what happens is that you max out at $15 strike price because, again, these shares right here are basically going to be used to fill this in case this sold option here gets exercised. Same thing. So things to keep in mind about with debit spreads here. So debit spread call debit spread does the same thing. You can do the same thing for a put spread if you're thinking, hey, Fridge, I think Webull is going to be just an awful stock. It's going to go down to $7.50. It's going to crash 40% or 30%, whatever it is. But I don't have $100 for it. I only have like $40 or $50 or whatever it is. Or maybe like, 80 or whatever. Okay, I can't afford this one right now, but what I'm going to do is I'm going to sell the option below to offset how much I'm paying for it. And as a result, I'm paying only $75 and my max return is $175. So it's not too bad. A better example would probably be these two strikes here. So buy the put at 220 and then sell the one right below it. Offsets your 220, cuts it in half, and it still gives you a nice return of about 50% or about, you're basically doubling your money here as a potential gain, which is absolutely amazing here. So that's a put debit spread compared to a call debit spread that you'll see as a result. So that's basically the idea behind it here. So debit spreads, credit spreads are very, very useful because you can sell options, you could buy options, but you don't need a lot of money up front. For example, SPY is a really good one to think about if you want to think about diving into options here. So say I want to go to SPY and say I want to go to even a year from now, June 18th, about a year out. I'm thinking that it's going to at least go to 615 and not hopefully have a bear market. Okay, cool. You want to buy the option here? Cool. It's going to cost you $5,000. I don't have that kind of money. Yeah, dude, I get it. Me too. Your profit's unlimited, of course, as you'll see here. But again, it's going to have a lot more hefty upfront price right here. All right. But I don't have the cash for that. Okay, so I'm going to sell a call option above it, and this is going to offset my cost basis. And watch what happens. Boop. $300 loss, $170 profit. Still a very good return. 171 out of $500. You're looking at, close to 40% return in about a year, which is absolutely amazing. And you're just hoping that SPY goes up. Hey, can you go up to 620, please? Please go to 620. Go up 1% between now and next year. Please, for the love of God. As long as it closes above 620 by next June, you've made 30-40% on your return, and you've put up a lot less capital up front. So what we're going to be doing here is, again, you're looking at individual stocks. You could do this with SPY ETFs or QQQ ETFs and everything, but looking at NVIDIA here for today's example, what you're going to do is you're going to go over to trade options. And again, we've done videos where you have to be familiar with the options chain here. Again, buying versus selling, calls versus puts, expiration dates. You need to become familiar with the options chain first before we do anything else, because other than that, this will be a challenge. Now, let's say that you are somebody within a scenario here where you are going to be bullish on NVIDIA long-term, saying, well, Fridge, I'm thinking that NVIDIA by the end of the year, December 19th, NVIDIA is going to go to, say, $160. So you're going to buy a call option because, again, the call option means you're basically hoping that NVIDIA goes up to 160. And as the price climbs higher and higher, you will see that you will be able to make some good money as a result. But the problem is saying, Fridge, I don't have $1,600 to pay for this strategy here. I'm bullish on NVIDIA, but I can't pay for it. And on the last video, we talked about spreads, how we did debit and credit spreads, where the idea was to make trading options cheaper, but it also limited your profit. This is kind of a similar idea here. And basically what we're saying is that I want to buy the option, but it's going to cost me $1,600. I don't have that money, Fridge. What do I do? So what you can do is you can say, I want to offset how much this is going to cost me. It's going to cost me $1,600. So what I'm going to do is I'm going to go up to a short date. Maybe I'm going to go 30 days out, 31 days here. And I'm going to sell a call option at the 160 strike. The exact same strike here, but I'm going to sell a shorter dated option at the same strike. Basically, it's selling a call option, which gives you down here. You're selling a call option, which pays you a premium up front here. And again, if you remember selling call options, it's a covered call essentially. And if it goes to 160, you would get rid of your shares. Then you're saying, well, Fridge, I don't have 100 shares. What do I do then? The good thing is that this bought call option is going to be your collateral. Because when you buy an option, it is equivalent to having ownership of 100 shares. So if you sell a call option at 160 and NVIDIA goes to 160 by the time this expires August 1st, this is going to be your collateral that you can exercise to then fill the order and you make your profit. As you will see, you make your maximum profit at that 160 strike. And what you'll notice is it does offset your price a little bit by about $400 cheaper, which is really good. Obviously, it's still $1,200, but it's $400 less. And again, it does cap out your profit here of $585, but you still are able to get some really good profits as a result. Now, the good thing about this long call calendar spread, also known as a poor man's covered call, is that say by August 1st, we don't hit 160, you can still hold this bought option, then go to September and sell another one, then October, and just keep offsetting your price that you pay by collecting premiums. So if it goes to 159 and it doesn't expire in the money, this expires worthless. You can then push out one for September, October, and do it again, because this option still has time because it is for December. So that's a long call calendar spread, and you can keep selling options over and over and over again to hopefully offset your bought call option for a longer date. So for a long call calendar, you buy a longer dated call option, you sell a shorter dated call option, but they both have the same strike. I hope that makes sense. Now, what you could also do instead of doing the call side, you could do the put side as well. So I could buy a long dated one and say, I think the video is going to be actually at 150 by expiration. But again, Fridge, I don't have $1,500 here to make this happen. Well, let me think that, short term, maybe it won't move to 150 by the very end of August or by the end of July here. So I'm going to sell a shorter term option here and get this premium up front. So here's how much I'm paying for the bought option. Here's how much I get paid for the sold option. And the difference is $960. So I offset it by $500 and something dollars. And again, if it goes to 150, I don't have the money to buy 150 shares or 100 shares at 150, Fridge. Well, this bought option does count as that collateral. So same kind of idea here. And again, 150 would be your maximum profit you would get here, but obviously it's very unlikely that's going to close at exactly 150. Maybe it's 151 or 143 or whatever, but you'll still make some good money as a result. So that's how calendars work. Now, instead of having it as a bought option, because this one is just a total cost here up front. This one you're just paying for it. There's another way to do a calendar spread here, but it's called a short calendar spread. And if you look at Robinhood here, they talk about it right here. It's a short put. And basically, this is what it looks like. It's the inverted version of the bought long call or put calendar that you'll see here. So this right here is a bought option where you have this. The short one is you're going to basically just flip the options around. So what is that going to look like? Well, what that's going to look like is that you would buy the shorter term option, 150, and then you would sell the longer term. Same strike, different expiration dates, but now it creates the inverted calendar spread here. It's a short one instead. And what you'll notice here, instead of it being a total debit, it's a total credit. So you're paid $967 here. But the difference with this one here is that since you are being paid a credit, you need to have the cash available to buy 100 shares at 150 as a result. You need that. So what you'll notice is that if you do go in and try to open this option here, like I try to do right here, say I want to go for 970, for example. When I go to review order, it's going to say you can't do it because you need to actually have cash collateral. Because again, you're being paid premiums, you're selling options here. You need to have cash available to actually open this trade here. So you can do the sold option and to be the premium collector here with a short put calendar. But the difference is you need to have the cash for collateral available, which in this case, obviously I do not, so I cannot open this up. But again, this one is basically still betting on NVIDIA to have some sort of movement, but as long as it moves in either direction between now and the shorter date of August 1st, if it moves way down to 130, great. If it moves way up to 170, great. It's almost like a straddle or a strangle, but instead of paying for it, you're being paid for it, as you will see here. You're getting that credit up front. Now, that's how the calendars work. And again, they are advanced level strategies here. You need level 3 access. You need a margin trading account in order for this to happen because, again, of these selling options and the collateral you do need margin for these trades to work. The last option trading strategy here is what's called a diagonal. Now, how does a diagonal work? Well, let's say that you are going to be bullish on NVIDIA still. You're going to buy a call option for, say, January. We'll go a little bit farther out here. Say you want to buy the 160 strike for January 16th of next year. You're like, okay, well, all right, Fridge, cool. Now, let's say that you're looking at the shorter term, though. Say you're looking at maybe October or something like that. You want to sell a call option here, but you don't want to do the exact same one here, because this is what creates a calendar spread here. But say you want to sell it and say, I want to give myself a little bit of leadway in case NVIDIA goes past 160. Because if it goes past 160, this option becomes worth a lot. But then my sold option would lose value, and the peak is at 160 exactly. Well, instead of offsetting this cost by, $1,100 and making only be $500, I can go a little bit higher up. Say I want to go to 180 here. And what this creates is what's called a diagonal. It's a shorter term sold option here. But the difference in these strikes here gives your option strategy some more room to run. In this case, as you'll see, it gives you more room to run here as a result. It's going to cost you $1,228 up front here for a cost. But since you're selling this option here, your max loss is actually just going to basically be, as long as this expires worth this year, your max loss is about $700. Which is like, okay, it's not too bad. And again, it gives your contract room to run. So if it hits 160, that's not the end of the world. It's not the peak at 160 like in the calendar, because your sold option is at 180. That's where you keep getting more and more profit. On the bought option is going to increase in value. And as long as you don't hit 180, then you'll hit that maximum profit at 180. And then once you hit 180, it kind of loses a little bit of profit here as a result. This is called a diagonal strategy here. So almost similar to a calendar, but the real difference here is that you're not doing the same strike. You're doing two different strikes here as a result. And the shorter calendar, or the shorter option that you're selling, needs to have a higher strike. So you can do this for, say, August. If you want to go 45 days out, so you want to do a 170, it kind of looks a little bit weird. But say you want to maybe do like a 180 maybe, or 185 or something like that. Again, you make a little bit, you'll get the $70 here as long as it doesn't hit 180. But if it climbs higher and higher, your bought option becomes worth more. And then once you hit that 185 strike price, you start to lose a little bit of value because this becomes in the money. But it's going to cost you, again, $16.75. So I wanted to open it. I would say, okay, let me do $16.79 here. It's going to cost me a lot of money, as you'll see. But it allows me, I don't need collateral or cash for shares or anything of that nature, which is really, really good. So first one we're looking at is what's called a long call condor strategy here. Now, this one is what's considered to be a neutral strategy here. So neutral basically means you're not looking for much movement in a stock between now and the expiration date. So, for example, SPY is a very, very common stock or ETF to really trade on the stock market because it's so liquid. It has a lot of strike prices, as you'll see here, and there's a lot of shares that are traded every single day. So it's a very, very good one to trade this with. When you're doing four-legged strategies like this, which is what you'll see here, as these are all four-legged strategies, I'm pretty sure. When you're doing four-legged strategies, you got to make sure you're doing it with a stock that is liquid. So you can get in trades and out of trades without having a lot of loss throughout the process. Because if you lose $5 to open it, just to open it, you're down $5. Just to close, you're down another $5. You're down $10 before the trade even does what you want it to do. So picking liquid stocks is obviously very important to understand while you are doing this. So a long call condor here is a neutral strategy. Basically, you're betting for the stock to not move, and you're basically buying what's called a call debit spread and selling a call credit spread with higher strike prices. And so we did videos about debit spreads and credit spreads last 2 videos ago, I believe. So take a look at that as well. But basically, you're buying a call debit spread and also selling a call credit spread at the same time. So we'll do the call credit spread part first to make it a little bit easier to work with here. Basically, you're going to look at me and say, Fridge, I think it won't go to 650. So I'm going to sell the call option, as you will see right here. So I'm going to sell the call option. But again, I don't have the shares to give away if it gets exercised. So if SPY goes to 650 by August 15th, then I don't have the shares. And what you could do is you can then what's called buying buying a call option right above it. And this gives you access to 100 shares as your collateral for this option right here. And it creates what's called a call debit spread, which is right here. So you're saying, okay, well, I'm looking to make sure that this is my credit spread. As you'll see, it's typed in as a credit spread right here. So basically, I'm hoping that SPY doesn't go to 650. And if it goes above 650, then this becomes loss. And again, the profit in the loss is not very good. Okay, you're risking $400 to make 70 bucks. Not a good risk reward ratio for a lot of traders. So what we can then do is what Robinhood says is that you can also sell. That was a sell in the call credit spread. We did this part here. Then we're also going to buy a debit spread. So buying a debit spread is a little bit different because what we're going to do, for example, is basically say, hey, I'm going to buy the 600 option right here. But again, I also want to sell a call option above it. Again, kind of like the opposite of a credit spread, you get paid up front. A debit spread is when you buy a strike and then you sell one above it as a result. And what you will notice that it creates this basically this window of opportunity for you to make some money here. And what you will notice is that your profit went up a lot more and your max loss went down a little bit as well, which is good. You increased your risk or your reward, and you decreased your risk, which is a good strategy to do for traders. Now, what you will notice is that you do have to pay for this option here. It's going to cost you $329, but it is definitely a lot better than having to hope that you don't have to buy share or give off shares of SPY. And again, if we get rid of this option that we just did right here, again, our max loss is $424. But with that extra leg put in here, this extra debit spread put in here, it changes our loss to go lower and it juices up our profit as well. It's almost a 1 to 2, so you're risking 2 times the amount to get 1 return basically for your risk to reward here. So it's not amazing still. Again, obviously as traders they want a little bit better, but this is an option which basically you're telling me that as long as SPY doesn't go down 3% or so or up 5% between now and August 15th, then you will be profitable as a result. So that is what's called the long call Condor strategy. Now, the difference here between the call one and the put one is the same thing, but instead you would do the put side option instead of the call side one. So very similar, but just do it with puts instead of with calls. Same idea though. All right. So that basically is what covers the long call. One thing to keep in mind about is your monitoring here. Is it monitoring or is it, let me see, maybe it is. So again, they worry about early assignment, which is a huge problem here. Which we do not want that to happen as a result, because then you got to give up shares, which you don't have. Theoretical max loss. Again, is it possible to lose more? Yes, if you are exercised, which again, this is why it's advanced level, because just because your theoretical loss is max at 329, you could lose a lot more if you are exercised early. So things to keep in mind about, make sure you're not exercised early as a result. Again, this option is going to be shares for this sold option here. And then this option right here is collateral for this one here. So that's why you do it. You don't want to do naked options ever, where you're just selling options and not buying anything for collateral, because that's where things can get very, very tricky and very, very risky. Those are level 4 options, which we'll never want to do. So again, the put side option of this strategy here, which you'll see on Robinhood talks about, is the doing the same thing, both puts instead. Now, when it says short call and short put, the idea is the same thing, but basically take this chart and invert it. And instead of having to pay the $329 here as a result, you will instead get paid that, and then your max loss would flip around and invert, because you're being paid up front for it. But the difference is you have to have more collateral in case that does happen. I know last video we talked about short diagonals and short calendars versus long calendars, where it said, hey, you need collateral for this one in case it goes against you. It's the same thing here, where the Robinhood is probably going to ask you for collateral, and if you don't have the cash collateral for the shares, you probably will not be able to open this trade at all. So things to keep in mind about while you're doing this. Again, if you're brand new to watching these options here, start off with level 1 and level 2, and you could build your way up. Come back to this video and watch it for level 3 and the advanced options here. Again, this is a good strategy because you're basically taking away and hoping that SPY doesn't move really too much in either direction. But you pay to have SPY not move. which is a good thing. You're basically just paying up front for it. Again, make sure you're managing your trades carefully, because if you just don't log in again, you might wake up one morning, get hit with a margin call, and that is not something that we ever want people to do. Again, this is informative videos. They're not actual trades that I'm recommending you do, but just to give you some ideas, when you ever see someone talk about a condor or the butterfly, this is what they're talking about right here as a result. All right. So that is the condor side. Now, what we also have is what's called the iron condor side. Now, the iron condor side actually looks very similar to what we just opened here, but it also revolves around there's a short condor and there's a long condor. Very, very similar ideas here, okay? So the one that I'm used to doing a lot of times is called the short iron condor, which basically means you'll be selling a credit spread on either side. Now, that last trade we just showed you was all about call options only. The iron condor focuses on calls and on puts as well, not just one or the other. So say, for example, we're betting that SPY won't go to 650. I'll do a credit spread for the higher side here, basically saying that SPY, I don't want to go to 650. And then what you could also do is that you can do the same thing, but on the put side. You can do a credit spread on the put side of your options here. So sell the 585, saying it won't go to 585. And then again, buying the put option that creates that collateral for the shorter option that you have right here. These two work together, and these two work together right here. So they're working together as collateral, and it'll create what's called a short iron condor. Now, why is it called a short one? Because you are paid a premium up front. So up front, you're paid $125, and it breaks down your max loss of $375. And you will need, if you go to review this trade here, you wanted to open it up, for example, which I can't because the market is closed. If I want to do a 125 here, you would have to have $500 in collateral. So $500 you put aside, and then you get paid a premium of $125 minus the fees. And as a result, as long as SPY basically trades between $585 and $650, you will capitalize on that premium and get the profit. And if it closes in between these two here, you are good. You will close the trade. It'll expire worthless. And then your collateral comes out and you keep the 125, and then you are done with the trade. So the difference here with an iron condor here is that you are doing a call side and a put side spread at the same time. And it creates this kind of like window, which is kind of similar to the actual long call condor specifically, but this one you're being paid up front. And if you want to see the other side of it, which you can call all these out here, let's flip it around to see what happens. Let's say I buy the 650 and I sell the 655. Again, that creates a debit spread instead of a credit spread. And then let's say that I go down to the put side and I buy the 585 and then I sell the 580 here. It creates, again, the inverted long iron condor. So the short one is the long one. So again, as you'll see, the max profit and the max loss flip around because I'm doing debit spreads instead of credit spreads. This one's going to cost me $125 only, and I'm going to have a max profit of $375. No collateral is needed. I just need to have the cash to buy this trade up front, which would be $125. And you get a risk to reward. You're risking $125 to make $375. It's a risk 1 to make 3 risk to reward ratio. To me, it's a better return potentially because you're basically hoping that SPY has some movement between now and August 15th. So that is the long iron condor and the short iron condor. So these ones here focus on just call side and put side, either option selling or option buying. And then these ones focus on the idea of having calls and puts on either side of my stock or ETF. And then the focus behind it is either say, if you want to bet there's a big movement in either direction, you have this here, which would be the better option. Or if you think SPY won't move much in either direction, you would do the selling side instead. This is a good strategy for stocks that don't move much as an option seller. For an option buyer, it might be better to do it this way because, for example, like Tesla, if you take a look at Tesla, for example, Tesla's always moving. Again, it's up 5% today, for example. It is going to cost you a little bit more. I can promise you that. But say you want to buy, where is, went too far down. Say you want to buy the 330, but again, you don't have $2,000 for it, so you can sell the 335. And again, that offsets your max profit, but it offsets your loss as a result. But then you're going to hope that also, I want it to move in either direction. So I'm going to bet that maybe it goes down to, say, 300. And then again, I want to offset my costs a little bit. And again, it creates this iron condor here, but it's a long one because you're paying more upfront. Now, this is not a good risk to reward because you're paying 380 to get basically back about a third of your money back as a result. And again, it's going to cost more because you're saying that Tesla's going to move about 6 or 5% in the next, month or so. And that's definitely going to happen pretty much. It moved 5% in a day. So it's possible this is going to happen here. And other people explain the strategy also as a way of looking at it as a strangle or a straddle, but with a little bit more cost effectiveness. So say you wanted to buy the 320 call option, you want to buy the 315 put option that creates the long strangle. Again, I don't have the cash. I don't have 5 G's fridge to pay for this, but I know Tesla's going to move in some certain direction. I don't care which way it moves, but just move somewhere, but I don't have 5 G's up front. Well, again, you can just sell the put option, sell the call option above it, creates the iron condor. But again, the risk to reward is very, very slim because it obviously is a very volatile stock. It's probably going to move. It's a very, very low reward for a very high risk. Depending on what you're looking at and what you're trading, definitely can make a difference. So that kind of gives you a glimpse into the condor strategy here. So again, condors are looking at doing either call sides only for long call condors or short or put condors. The iron ones focus on having calls and puts together. Now, the last one to talk about is the butterfly. Now, the butterfly basically is a 4-legged option strategy here, but it does involve something that's a little bit different. So a long call butterfly, and if you're focusing on just call options, which makes a lot of sense, has 3 legs, but it's 4 options in total. Okay, you're going to buy 1 call, sell 2 higher strike calls, and then buy 1 even higher strike call. So what does that mean? Okay, well, we're back on Tesla here. So let's say I want to buy the 320 call option here. Again, I don't have $2,450. Okay, cool. I'll sell the 325 here. Okay. Max profit, max loss. Again, as long as SPY, you're basically telling me, not SPY, basically saying that Tesla has to be super bullish here. This is a bullish looking strategy here. You're basically saying that Tesla has to go at least up 3% between now and August 15. Okay, that is a call debit spread. But now let's say, again, you can adjust what's called the ratios, which basically means that you can buy more of a contract compared to sell more and vice versa. So if you go to this custom option right here, you can change how many you're going to be looking at here. And what you can do is you can say, well, instead of just selling 1 option, I'm going to sell 2 options. Why is that? Because what it does is it gives me a premium upfront fridge, and that's amazing because I like to be the option seller. I want to cash in on that money. But you can't do that so quick because remember, if Tesla goes to 325, you now need 200 shares to offload in case Tesla goes above 325, which again is over $60,000, which you don't have. But you do have 100 shares worth of collateral here as a bought option here. But instead of doing, a 321 here and limiting it, you could technically buy the one higher than this one maybe, and it creates this nice little image of a butterfly here because with this bought option at 330 and this bought option at 320, what it does is these 2 bought options count as the collateral for these 2 sold options. And what you're going to notice is you hit the max profit at 325, which obviously is very unlikely to happen because it will never close at 325 exactly. But if you take a look at this option here, it only costs you $15 to open up at the very beginning of the trade. $15, no collateral needed, just $15. If Tesla goes down super low, these will maximize profit. You'll lose the returns on these two bought options. So if Tesla comes down to 300 and 200 or whatever, these sold options get maximized as premiums. These two bought ones become worthless. The difference is the $15, and that's it. Now, obviously, as you will see, the risk that you will have here, and I'm going to talk about, I'm sure, down here. If you go to, so again, here's your butterfly map that we're looking at here. Again, it is possible if you have early assignment here, potentially, okay? So things keep in mind about, whereas if Tesla goes above 325, you may get said, hey, we want to exercise the shares at 325. And you would have to offload these two options here as your collateral to cover the 325 sold options here. But at expiration, theoretical gains are absolutely unbelievable, and it costs very, very little to open up a trade here. So this is called a call butterfly. Now, you can do the same thing for the put side, very, very similar. You're bearish on Tesla. You can do the same thing, but do puts instead of calls, which what that will look like is very, very similar, so you can see what it looks like. So say you want to be bearish on Tesla. I think it's going to go to 300 fridge. That's what I'm thinking. It's a good number. Okay, but I don't have $1,700. I'm going to sell the 295. And then you would buy the 290. And what you would do is you would go to custom. You go over here, hit custom ratio, and you'd make this be 2 sold options instead of 1. And these 2 sold options obviously create the iron butterfly, or the butterfly method here, but it's a put butterfly instead. And again, believe it or not, $15 to open and a very, very high profit, but a very, very low risk, which is a good trade. But you are basically, these trades are very advanced because you need to be spot on with your predictions. The minute that it goes below 290 or above 300, you're automatically going to be losing out on that $15. But if you want to just throw money at it and hope for the best, you definitely can. This is a very, very low probability, but things to remember as well, you don't have to wait until expiration. You can close these early. So if Tesla goes down 10% tomorrow, you might already capitalize on these returns and then just close it out in one day trade and be good to go. You do not have to wait the 44 days until expiration. So things to keep in mind about, but this is your put butterfly, as you will see, the put butterfly here. Same visual, but just put side instead of call side. Now, the short side obviously is flipping it. So you would sell this one, buy these two, sell this one instead. And what that would look like is, let's do it again, because why not? So I'd sell the 300. I would buy the 295. I would sell this one. And then I would change my options here. So unique ratio and do 2 bought options to offset here. And again, it creates this basically, again, risk to reward is awful, but you're getting paid a $15 premium up front here, but risk to reward is awful. $15 and you're risking $485. Not a good risk to reward, but as long as Tesla doesn't go between 290 and 300, then you're good to go. Same kind of idea. Very, very high probability of this happening, but also if it does end up happening, you lose out on a lot of money. And I do want to see, I want to guess they're probably going to ask for collateral as well. Let me just double check. Oh, only $500 in collateral. Okay, so that's not as bad still, so you do need to have collateral here. But, you know, very, very low risk. Not a lot of money to be made on that trade, obviously. That's the short option of it. And then the last one that we're looking at is the iron butterfly. So the iron butterfly here basically is a 4-legged volatility strategy that involves buying both an at-the-money call debit spread and an at-the-money put debit spread at the same time. Okay, so they give you an example down here, which we can take a look at. I think we already basically did one of these here, which is pretty amazing. So basically, you're buying a put below and then selling a put below that one. Yeah, this is basically the same thing as the other condor that we did from before. So that's basically it. So that covers kind of what butterflies are and condors are in this case. Again, these are more specific advanced strategies. If you have done your research, done your due diligence, and you feel very confident that it should trade around this price by this time period, obviously, you hope that in the time period you're looking at, you don't need to wait until expiration. Because again, the likelihood of having an option to hit the exact max profit or max loss in this case is very unlikely. So that's what I like to keep in mind about when I'm doing these kind of options here, is that these are done to be hopefully exercised and closed out early. So close these positions early. Do not wait until expiration, because it obviously may lose value over time. We've done cover calls, we did cash secured puts, we did buying options, we did straddles, we did strangles, we did collar, we did credit spreads, debit spreads, calendars, diagonals, condors, butterflies. I think we covered all the major option strategies here as a result. If I find out more, I'll add more to this kind of series here. But thank you guys so much for watching. If you made this from the video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. I hope you're making money in the market in some way, shape, or form. And as always, I will see you in the next video.